Hi folks, Rick Wedell here. Today is Thursday, May 21st, and I thought I'd come to you with a brief market update on exactly what's going on out there. The S&P 500 is currently trading right around 2960, which is down about 40 basis points for the day, but clearly way higher than that 2800, even 2900 range that we've been talking about previously. That was fueled by some gains earlier this week around vaccines, around some news on vaccines, which is something we'll talk about later in the video. We're off a little bit today because of a little bit of trade rhetoric that is going on between the United States and China. There were some tweets overnight from the administration basically criticizing the Chinese government and their handling of the virus. There's been Senate passage of a bill that would block Chinese companies or help prevent Chinese companies from listing on U.S. exchanges. And any sign of flare-up in those trade tensions is something that's going to give the market a little bit of pause as they think about the necessity of trade between these two countries in building sort of the global recovery from this pandemic. So anytime that we see any type of tension between those two countries, we're going to see a little bit of a sell-off. It remains to be seen whether or not the tensions that are going on between the two countries would actually threaten the phase one trade deal that we reached late last year. So we'll just have to see as that goes forward. Away from that, we saw unemployment numbers out this morning. Another 2.4 million people filed for unemployment. That is quite a lot of people, although it is nice to see that number on the downtrend. That brings to 40 million people in total, the number of people that have now filed for unemployment as a result of the coronavirus. But I would once again remind folks that most of those layoffs are viewed as temporary, both by the people that are unemployed and by the people that laid them off, which is a very good sign. When we tend to see high percentage of temporary layoffs, that tends to lead to a rapid bounce on the other side of it, as opposed to 2008 or 2001, where a lot more of those layoffs were listed as permanent from the get-go. So that's a reasonably good sign that that we will see that number start to bounce back as economies reopen. Would note that the Treasury Secretary earlier today did call for potentially the need for some additional stimulus as we get through it. That's actually something that's viewed positively by the markets, that we might see some additional federal and or fiscal stimulus to come out of either Treasury or the federal government. The Democrats have had a bill out there to try and provide some additional stimulus. Obviously, there's some political wrangling that's going on with that football. But the markets do view any sort of additional stimulus measures as a positive. And the other thing that's going on out there that is quite interesting is all the news around reopening, which the markets are taking as a positive. So all 50 states at this point have at least some form of relaxed restrictions. It's a little concerning that two of our largest economic engines, California and New York, seem to be lagging a little bit behind the rest of the country on their reopening path. Obviously, if you think about the size of those economies, we prefer to see them up and running sooner rather than later. And JP Morgan actually came out with a fascinating piece this morning demonstrating that across whether it's states that have reopened here, Georgia being the first, or whether it's countries over in Europe, Denmark being the first, that infection rates have actually gone down post-reopening, not up. Which is a great sign for the overall market. It indicates that if we can open our economies safely and not necessarily risk a massive flare-up of the virus, at least on a seasonal basis. And there are a variety of reasons for that. The people that get sick first tend to be the people that are most vulnerable to begin with. A little bit of a buildup of some herd immunity, some seasonal weather changes, et cetera. But it's great news to see. Denmark opened up 34 days ago, which is long enough to be able to see some type of virus spike up, and they haven't seen that so far. So that's good news on the virus front and good news on the reopening front. That reopening is driving oil prices up as we start to see more people driving around. Traffic levels are coming close to normal in a lot of the different economies that have opened up, and that's driven oil prices up to about $34 a barrel. That's still well shy of the sort of $50 a barrel, which is most of the clearing price for West Texas crude or for the drillers that operate out in Texas and Oklahoma. But it's certainly nice to see it out of the teens, and the markets have taken a positive view of that movement. And last but not least, we've had positive data this week on the potential development of vaccine. So there are over 100 different vaccines that are currently in development in some way, shape, or form around the world. There is a ton of money and research being poured into the development of a vaccine. And it's not surprising that when we get a little bit of positive news on any one of these, that we see the market pop up a little bit. And it means that we should be careful about how we position our portfolios going forward when we know that there is the potential of any given day to get some positive news on a drug or a positive news on a vaccine and see the market, race up 3, 4, 5%. It means that you need to be careful about positioning overly defensively because that news, hopefully, will come out sooner rather than later. So with that, as always, if there are any questions, please feel free to reach out to either myself or your advisor. I hope you have a lovely holiday weekend, and I look forward to talking to you again soon.